If you think silver is calm right now, you are looking at the wrong screen. What is unfolding beneath this quiet price action is not a correction, not a pause, and not routine volatility. It is the early stage of a structural fracture between East and West that could redefine how silver is priced globally. Today is Monday, 16th of February 2026. U.S. financial markets are closed for President's Day. Liquidity is thin. The quoted price of silver sits at $76.32 per ounce at the time of recording. To most traders, that number feels stable, almost boring, especially when compared to the explosive run in January when silver surged to $121.65. A drop from $121.65 to $76 looks dramatic. It feels like a reset, but that surface-level interpretation misses what is actually happening. While Western screens show stability, Shanghai is flashing warning signals that the paper market is not fully pricing in. Across the Pacific, the Shanghai Gold Exchange and the Shanghai Futures Exchange are facing conditions that insiders have begun calling a ghost squeeze. The term sounds theatrical, but the mechanics behind it are precise and measurable. A ghost squeeze occurs when physical metal that is supposed to back exchange contracts effectively disappears from circulation. Short sellers remain obligated to deliver silver that they cannot source. The metal becomes a ghost. The obligation remains real. To understand why this matters, you need to understand how the Shanghai Gold Exchange operates. Unlike Western futures platforms that frequently settle contracts in cash, the SGE is built around physical delivery. When participants buy silver contracts there, the expectation is that actual metal changes hands. It is not merely a financial difference settled in currency. The Shanghai Futures Exchange, known as the SHFE, complements the SGE by handling standardized futures contracts with specific delivery months and margin rules. Together, these exchanges form the backbone of China's precious metals infrastructure. Right now, both exchanges are showing strain. The clearest signal is backwardation. In a healthy commodity market, futures prices trade slightly above spot prices due to storage costs, insurance, and financing. That structure is called contango. Backwardation flips that relationship. It occurs when buyers are willing to pay more for immediate delivery than for future delivery. It signals urgency. It signals fear of shortage. It signals distrust in the promise that metal will be available later. In February 2026, the SGE entered pronounced backwardation. Buyers are paying substantially more for silver today than for contractual promises of silver tomorrow. That is not speculation. That is stress. Short sellers who positioned against silver during its January climb to $121.65 are now discovering the difference between paper markets and delivery markets. In New York, on Comex, a short seller can often roll contracts forward or settle in cash. In Shanghai's delivery-oriented structure, the obligation to provide metal carries more weight. When shorts cannot deliver, they must pay daily deferral fees to long holders. Those fees are not symbolic, they are financial transfers. Every day the metal fails to appear, the short side pays the long side for the privilege of postponing settlement. It is a slow bleed. This is the essence of the ghost squeeze. The contracts exist. The obligation exists. But the metal required to satisfy those contracts is not sitting in vaults in sufficient quantity. The cause is not mysterious. It is industrial demand. China's solar photovoltaic industry consumed record volumes of silver throughout 2025. Early data from 2026 indicates acceleration, not slowdown. Silver is a critical input in solar panels, and each panel permanently locks that metal into long-term infrastructure. At the same time, China's semiconductor sector has expanded production capacity. Silver is essential in conductive pastes, electrical contacts, and advanced chip packaging. When these industries scale, silver consumption scales with them. The combined effect has drawn down domestic inventories to levels not seen since 2016. Analysts at Sichuan Tianfu Bank described the depletion of deliverable material as reaching an emergency stage. That is not language used lightly within conservative financial institutions. It reflects genuine concern. The SHFE has responded by tightening rules. Naked short positions by non-members are now banned. Participants who wish to short silver must demonstrate verified hedging needs tied to legitimate commercial exposure. Pure speculation without backing is restricted. When an exchange alters participation rules mid-cycle, it signals institutional awareness of risk. Exchanges do not intervene casually. They intervene when confidence must be preserved. Meanwhile, Shanghai premiums over Western spot prices have approached 10% in recent sessions. That premium means buyers in Shanghai are willing to pay significantly more than the $76.32 screen price for immediate delivery. On paper, this looks like an easy arbitrage opportunity. Buy silver in New York at $76 and sell it in Shanghai at a premium. In reality, moving large quantities of physical silver across continents involves shipping logistics, insurance, assays, regulatory clearance, and time delays measured in weeks. During those weeks, shortages can intensify further. Arbitrage exists in theory. In practice, friction prevents instant correction. The $76.32 price visible today reflects Western futures trading under holiday-thinned liquidity. With U.S. markets closed, algorithmic systems dominate volume. Algorithms respond to currency movement, momentum signals, and technical patterns. They do not physically inspect warehouse inventories in Shanghai. They do not respond to industrial consumption trends in real time. The price appears calm because participation is thin. It is a price floating in reduced liquidity. When New York reopens, price discovery will incorporate fresh data. But even then, paper markets often lag physical realities until pressure becomes undeniable. Silver does not observe holidays. Metal continues moving from vault to factory, from exchange warehouse to industrial facility. Each ounce embedded in a solar panel or semiconductor effectively leaves monetary circulation. Recycling remains limited at current price levels. Structural deficits compound year after year. The Ghost Squeeze is not a headline event. It is a gradual tightening process. Each day, deferral fees are paid. Each week, inventories decline. Each month, industrial demand expands. Backwardation is not random noise. It is the market's signal that present supply is more valuable than future promise. The question is not whether tension exists. The question is when that tension will fully transmit into Western pricing. The apparent calm at 76-32 masks a deeper imbalance. Beneath the surface, a rebalancing is underway. And when paper markets finally align with physical scarcity, the adjustment rarely unfolds slowly. This is not about panic. It is about arithmetic. And arithmetic in commodity markets eventually asserts itself. While Shanghai tightens under the pressure of backwardation and delivery strain, the Western silver market is confronting a different kind of shock, one that began not with physical shortage, but with monetary expectations. In early February 2026, the nomination of Kevin Warsh to lead the Federal Reserve sent a ripple through global markets that quickly became a wave. Warsh, a former Federal Reserve governor who served during the 2008 financial crisis, is widely considered a monetary hawk. His nomination was interpreted as a signal that accommodative policy could give way to tighter financial conditions. The U.S. dollar strengthened sharply. Yields responded. Risk assets wobbled. Silver did not escape. From its January high of 121.65, the metal corrected approximately 26%, falling back toward the 76th range. On the surface, it looked like the rally had been decisively rejected. But the mechanics of that correction tell a more nuanced story. The decline was driven largely by leveraged futures traders who had accumulated long positions during the January surge. As prices slipped through technical support levels, stop-loss orders triggered automatic liquidation. Margin calls followed. Algorithms accelerated the momentum. The unwind was mechanical, not fundamental. Beneath that forced selling, physical accumulation continued. This divergence between paper liquidation and physical demand has rarely been more pronounced. The futures market corrected violently. The physical market did not. Institutional buyers and sovereign entities continued to secure metal, even as speculative capital exited leveraged positions. The Warsh nomination shock was a paper event. It did not create new mine supply. It did not reduce industrial consumption. It simply changed expectations for monetary policy. Now turn to Comex, the primary Western futures venue for silver. On February 11, 2026, registered silver inventories fell below 100 million ounces for the first time in this cycle. The reported level was approximately 98.1 million ounces. That figure matters because registered inventory is the portion designated and available for delivery against futures contracts. Eligible inventory, though stored in approved vaults, is not automatically available for settlement. Only registered metal counts when delivery is demanded. At the same time, open interest across active delivery months represents claims on roughly 48 million ounces. When that open interest is measured against 98.1 million ounces of registered supply, the leverage ratio approaches 4.16%. In other words, there are roughly 4.16 paper claims for every single ounce immediately available for delivery. That ratio functions smoothly only as long as most contract holders roll forward or settle financially rather than demand metal. Historically, that assumption is held, but the environment is changing. Large institutions have begun adjusting behavior. J.P. Morgan, operator of one of the largest precious metals vault systems globally, has been observed converting eligible silver into registered form. Such conversions often precede withdrawal. Sprott Asset Management, through its physical silver trust, has likewise been active in securing metal. These entities are not speculative day traders. They understand structural risk. When they move metal closer to physical possession, it reflects precaution, not impulse. The CME Group, which oversees Comex, responded to volatility by raising margin requirements on silver futures to 15%. Margin increases reduce speculative leverage by requiring traders to post more capital. Weaker participants exit open interest contracts. But higher margins do not create additional ounces. They address volatility, not scarcity. In fact, concentrating remaining positions among well-capitalized participants may increase delivery risk. Strong hands can afford higher margins. Strong hands can also demand delivery. The exchange's attempt to cool speculation may inadvertently leave a more resilient group of participants capable of pressing claims. Overlay this with global supply data. The Silver Institute projects that 2026 will mark the sixth consecutive year in which global silver demand exceeds combined mine production and recycling. Since 2021, cumulative deficits have approached 820 million ounces. That number represents real metal consumed and not replaced. To put it into perspective, 820 million ounces is roughly 80% of a full year of global mine output. That supply gap does not close quickly. Bringing a new silver mine online typically requires 7 to 12 years from discovery to production. Even optimistic timelines push meaningful supply expansion into the 2030s. This structural imbalance is why many analysts argue that the 76.32 level reflects paper dynamics more than physical fundamentals. Futures markets can generate contracts rapidly. Physical mining cannot. Meanwhile, Shanghai premiums near 10% over Western spot prices continue to signal tightness in Asia. For decades, price discovery was dominated by New York and London. If Shanghai consistently bids above Western prices for physical delivery, the gravitational center of pricing power shifts. China and India together represent the largest centers of physical silver demand. If Eastern markets refuse to transact at Western paper valuations, eventual convergence becomes a question of timing rather than possibility. Retail indicators reinforce tightening conditions. Mints in Australia and Canada have reported elevated demand. Fabricators face longer lead times for certain products as sourcing blank silver becomes more complex. These are early stress indicators rather than full shortages, but they align with exchange-level data. Now consider the approaching March delivery cycle. Delivery months test the integrity of the leverage structure. If a significant share of contract holders chooses physical settlement rather than rollover, registered inventories face accelerated drawdown. In extreme scenarios, exchanges possess authority to declare force majeure, settling contracts in cash under extraordinary circumstances. No such declaration has occurred. But the mere discussion influences institutional behavior. Rational actors prefer certainty of possession over reliance on settlement mechanisms. Bank of America strategists have outlined price scenarios between $200 and $300 per ounce should persistent supply deficits continue. That projection is not based on speculative enthusiasm. It is derived from modeling supply elasticity against sustained demand. At $200 per ounce, the entire global silver market would still represent a modest capitalization relative to major technology firms. That comparison highlights how small the silver market remains compared to the scale of capital-seeking returns. China and India appear to view Western price weakness as opportunity. Metal continues flowing west to east. For that flow to reverse, Western spot prices would need to exceed Eastern premiums decisively. That would imply substantial repricing. The silver market today operates on thinner margins of confidence than in previous cycles. Inventory buffers have shrunk. Leverage remains elevated. Industrial consumption accelerates. Regulatory adjustments tighten participation. Each element alone might be manageable. Together, they form a compressed system. The calm displayed at 76.32 does not invalidate structural strain. It reflects temporary balance within a leveraged framework. When liquidity deepens and delivery intentions clarify, price discovery may adjust swiftly. The divergence between paper and physical markets has rarely been so pronounced. And as March approaches, the question is no longer whether tension exists. The question is how it resolves. As the March delivery cycle approaches, the silver market stands at a point where arithmetic, not opinion, begins to dominate the narrative. What we are witnessing is not a speculative frenzy. It is a compression of structural forces that have been building for years and are now converging. 6 consecutive annual supply deficits cannot be dismissed as coincidence. Since 2021, global demand has exceeded combined mine production and recycling every single year. The cumulative shortfall now approaches 820 million ounces. That figure is not theoretical. It represents real metal consumed, transformed, and removed from the monetary system. Nearly 80% of an entire year's global mine output has effectively vanished into industrial infrastructure during this period. Silver embedded in solar panels does not reappear in vaults. China's photovoltaic sector continues expanding capacity, and each installation locks metal into 20 to 30-year lifespans. Semiconductor manufacturing does the same. Silver used in advanced chip packaging and conductive pastes becomes part of complex electronics that will eventually end up in landfills rather than refineries. Recycling remains limited because extracting dispersed silver from finished products is rarely economical at current prices. This is why backwardation in Shanghai matters. It is not a speculative anomaly. It is a signal that present supply carries more value than future promise. Buyers are willing to pay premiums approaching 10% above Western spot prices for immediate delivery. That premium reflects urgency, not enthusiasm. It reflects limited availability. Meanwhile, the Western price remains anchored around 76.32, a level shaped primarily by futures activity under thin liquidity conditions during the President's Day closure on Monday, 16th of February 2026. Algorithms can maintain stability in low-volume sessions, but liquidity does not eliminate imbalance. It only delays recognition. The March delivery cycle represents a stress test. Registered inventory on Comex stands near 98.1 million ounces, already below the psychological 100 million threshold. Open interest equivalent to roughly 48 million ounces produces leverage near 416%. Historically, that structure has functioned because most participants prefer to roll contracts rather than demand metal. Confidence underpins the system, but confidence is not static. It shifts when conditions change. Large institutional actors appear to be adjusting positioning. JP Morgan's conversion of eligible inventory toward registered status suggests preparation. Sprott Asset Management's accumulation through physical trusts reinforces precaution. These entities understand delivery mechanics intimately. They recognize that when leverage rises against shrinking inventory, optionality becomes valuable. Margin requirements on silver futures now sit at 15% following the CME's adjustment. Higher margins reduce speculative excess, but they do not produce additional ounces. They do not refill warehouses. They do not slow industrial demand in Asia. They simply alter the cost structure for participation. The possibility of force majeure remains hypothetical, yet it cannot be ignored. In commodity markets, force majeure declarations occur when exchanges acknowledge inability to fulfill delivery obligations due to extraordinary circumstances. Settlement would occur in cash, not metal. For participants seeking physical possession, that distinction matters profoundly. Even if such an event never materializes, its theoretical existence influences behavior. Investors who understand systemic risk often act before certainty emerges. Bank of America's projection of potential price ranges between $200 and $300 per ounce under sustained deficit conditions reflects supply elasticity modeling, not speculation. If demand continues to outpace production and recycling, price becomes the balancing mechanism. At $200 per ounce, the entire global silver market would still represent a relatively modest capitalization compared to leading technology corporations. That reality underscores how small the silver market remains relative to global capital pools. Geopolitically, the migration of metal from west to east carries implications beyond price. For decades, New York and London dominated price discovery. If Shanghai consistently commands premiums and absorbs physical supply, pricing power gradually shifts. China and India together represent the largest centers of physical silver consumption. Their willingness to pay above Western paper prices signals strategic prioritization. Reversing that flow would require Western spot prices to exceed Eastern premiums meaningfully. That implies upward repricing. Until then, the path of least resistance for physical metal remains eastward. It is important to recognize that structural shifts often unfold quietly before becoming obvious. The Ghost Squeeze did not begin with a headline. It began with backwardation, with deferral fees paid daily by short sellers unable to source metal, with regulatory tightening on naked shorting within the SHFE, with inventory reports showing steady drawdown. Each data point alone might seem manageable. Together, they form a coherent pattern. The silver market is small relative to global financial markets. It does not require enormous capital flows to produce outsized price movement. When inventory buffers thin and leverage remains elevated, volatility potential increases. The calm at 76.32 should not be mistaken for equilibrium. It represents a momentary balance within a system under strain. Markets resolve imbalances through adjustment. Sometimes that adjustment is gradual. Sometimes it is abrupt. The timing of repricing is difficult to predict precisely. But the variables driving it are visible. Supply deficits persist, industrial demand accelerates, premiums widen, inventories decline, institutional behavior shifts. For holders of physical silver, the distinction between possession and exposure becomes central. Futures contracts offer participation in price movement, but they rely on settlement infrastructure. Physical metal eliminates that counterparty layer. In environments where delivery stress is discussed openly, strategic actors tend to prefer certainty. Silver is not merely a precious metal. It is an industrial cornerstone of renewable energy and advanced electronics. It remains finite. It remains irreplaceable in many applications, and it remains historically undervalued relative to its strategic importance. As markets reopen following the holiday closure, liquidity will deepen. Traders will reassess inventory data, Shanghai premiums, and positioning into March. Whether repricing begins immediately or continues building quietly, the structural forces remain unchanged. The ghost squeeze that began in Shanghai is not isolated. It is a reflection of cumulative imbalance across the global silver system. When paper structures meet physical scarcity, price eventually bridges the gap. The 76.32 level should not be viewed as a ceiling. If anything, it may represent a floor forming under structural pressure. Each ounce leaving Western vaults reduces flexibility. Each premium paid in Asia reinforces scarcity. Each delivery cycle tightens the coil. When markets finally align with arithmetic, the move rarely announces itself in advance. It simply happens. And those who understood the mechanics beforehand will recognize that what appeared calm was in fact compression waiting to release.